Hello and welcome to this Money Control live stream. I am Nandita Khemka and I want to discuss today the latest rate hike that has been undertaken by the US Federal Reserve, which is a 75 basis point rate hike. And this is the third time that the Fed has doled out such a massive rate hike as it looks to tame inflation. Now, what should investors do in light of this recent rate hike and how will the Indian markets pan out from here? Well, to put all this in perspective, I called up my senior consulting editor, N. Mahalakshmi, and decided to get her on to kind of explain what investors should be doing at this current juncture. So, good morning, ML, and thanks a lot for joining us. I want to ask you, this is the third straight 75 basis point rate hike coming in from the Fed. And in these inflationary times, looks like 75 is the new 25. What do you say?
It definitely feels, Nandita, like this is the new 25, but let me assure you, 75 is not 25. So so let's just put this in perspective. Obviously, we've gone to the other end of the interest rate spectrum for a long time, and we were at ultra low rates, close to zero, and inflation is upon us, and it's stubborn and sticky. So this sort of a hike was required, is required, and I'm not surprised that it came in at 75. In fact, a minority of investors were expecting something more than that. People were also expecting a 100 basis point rate hike, but my own feeling was that 75 would be okay, and so that they can sustain this rate for quite some time. So it's pretty much in line with expectation. And I don't think we should, after the last policy, if you recollect, there was people were really interpreting, the market really interpreted this whole 75 basis point and Powell's speech as being slightly dovish. And that was obviously incorrect. We pointed out at that time also that the only statement he made was that the hikes will depend on economic data, and he has pretty much maintained that through and through. If we were to just go by that statement, we are still a long way off from the 2%. And this time again he is reiterated, that 2% target, because the referring to that 2% target sort of anchors your expectation very differently. So we shouldn't get complacent about this. These rate hikes are very much to stay, and it's not going to, this pain is going to last for some time.
So he has obviously hinted that there will be more rate hikes coming, but ML, speaking about rate hikes, they do take some time to percolate into the economy, right? So there is a section of market men who do believe that maybe he's being in too much of a hurry to raise rates by such a huge quantum. So do you think he should actually go a little slow and kind of reduce the quantum of these rate hikes?
So Nandita, this is, when he wasn't hiking rates, we were all complaining that, oh, now Fed is really complacent. They're not hiking rates. They're not recognizing the reality that inflation is sticky. It is not transient and permanent and all that. Now that he is hiking rates, we want to believe that it should be at a lower pace. I don't think you will ever have 100% agreement on what should be the right quantum, but I think largely 75 basis point is the trajectory that he is taking now I think is the right trajectory. 75 is not too much, considering how far we need to travel to get to that 2%, and how much is in the Fed's hand itself is right now unknown. So we are dealing with a lot of unknowns and unknowables, as some will put it. I think we are on the right trajectory. I think the Fed is on the right trajectory.
Right, right. So coming to the market action, we've seen a decent open today for the Indian markets, given the fact that the Dow tumbled over 500 points overnight. And even like year to date, I think Indian markets have really outperformed their US peers. So is it right to say that Indian markets have largely decoupled from global markets?
Yeah, so people who have experienced 2008 are really scared of this term called decoupling, because a lot of people predicted that then, and it didn't really pan out. And at this time, even now, if you ask people, they will not say that India is decoupled, despite the fact that this year alone we have sort of been pretty much at the same place, while markets in US have gone down about 20%, right, from year to date. in a sense, we have been starkly different from the rest of the world, including the United States. But that does not mean, again, this time also, it doesn't mean that US markets will continue to be in pain and we could be in positive trajectory. So I think the direction will continue to be the same, because these are factors that are going to affect us, because we also depend on foreign inflows. Not entirely, there is some counterforce which is developed in terms of domestic flows, etc. But we are still in a very globally connected world. So we shouldn't still use the word decoupling, but the market has given the verdict that we are a different market, and today our market is seen as an asset class in itself, and that is why you see this stark contrast in performance.
So I know there is a lot of volatility in the market right now, but we did see the Nifty regaining that 18,000 mark, and a lot of people did say that okay, by Diwali we may like see a fresh high or something. Do you see the chances of that happening now, given the fact that there's so much volatility and that Nifty has once again gone back to the 17,500 mark?
In my in If you ask me, in markets, you have to sort of, have this etched in your mind, never say never. So it could happen, but if you
Right.
ask me what is the probability that it will hit a new high in the wake of the present circumstances, I wouldn't really put my money there. It could be, and I say it could be only because of the sense that you get from all talking to all the foreign investors and people at conferences, etc. I think there is a distinct feeling amongst foreign investors now that they have missed out on something. They misread the Indian markets, because you've seen the strength over a period of time. The fact that you would not have, probably lost money. Uh,
And we've seen them
Equities.
make a comeback last month itself. Even though this month the flows have slowed down a bit, but
Correct.
they
So
have
people who
really
have not participated have this feeling that they have really missed out on
have
something.
missed the bus. Yeah.
But I think the other side of the story is also, you have to be very watchful of the rupee. We keep looking at the Nifty and say this is where it is, but you have to look at the dollar returns. We have come off, like, 73 rupees to 80 rupees, so it's quite an erosion in that sense.
Right.
So net, India is a better market, but I don't think we should get over optimistic and say, hey, we are completely different and our story is going to be completely insulated from the rest of the world and we'll hit new highs and we are in a new bull market. I wouldn't bet on that.
Right. When you spoke about currency, I want to obviously bring up the IT fact. We've seen that sector, getting hammered out of shape. Now, given the fact that we've seen the US yields also surge quite a bit, do you think it's time to avoid the IT sector now completely? And of course, my next question is, I mean, can you put into perspective how rising yields actually impact IT shares? I know it's a lengthy
Okay, so
answer, but maybe you can just explain it in a
yeah.
concise
So
way.
first of all, there is no relation between rising yields and IT shares per se. I mean, there is no unique relationship between rising yields and IT share at all. It's a complete misconception, because in the US, the sharpest falls we have seen is in the technology stocks, and therefore people sort of think that, US
Hmm.
technology is weak, so Indian technology should be weak. That again, it has a rub-off effect, but fundamentally speaking, it does not work like that. I think IT shares are primarily weak, essentially because there is anticipation about recession in the US and Europe and all over the world, and these are really the big markets for IT shares. So there is an expectation that growth will certainly not continue at the pace at which it happened during the pandemic. It will slow down a bit, but the market obviously had priced in these shares for at a higher level for a longer period of time. So that is going to come off, and that's why I think there is a certain correction in IT stocks. Coming to yields versus valuation, the real connection is between yields and equity valuations. So this again is a very long winding answer, but I'll tell you in like just one or two sentences what this means. So when the yields go up, the cost of debt, that is the price at which companies raise debt, that goes up, and the cost of equity goes up. So the overall cost of cost of capital for companies go up. So when you value a company, what do? You arrive at the intrinsic value of a company, but by just looking at the future cash flows and discounting it to arrive at the present value of company. So the discount rate that you use for this purpose is the cost of capital. So when the overall cost of capital goes up, okay, the overall rate goes up, then the final price that, or the final present value that you arrive at after discounting your future cash flows is going to be lower. So the intrinsic value of those companies will be lower if you assume a higher cost of capital. So that's the real relationship. And that's why the US tech has corrected, because you have assumed future cash flows, because many of these companies are not profit making. Even here, like companies like Nike, you would say that they will, or, several other new economy companies, the first year of profitability will be 2025 or 28 or something. And then you are assuming that they're going to be winners and the cash flows are going to be stronger. So the longer that distance, even a small escalation in cost of funds will ensure that there is a larger contraction in the intrinsic value. So that is why the tech companies, which had P's or in their hundreds, have seen that sharp correction. So the here also, I think that logic will apply to highly valued companies, and for all you care, it would even be companies like Nestle or some of these companies which have also seen, by the way, some correction, a lot of quality stocks, etc. Those benefited when the rates were going down, exactly for the same reason. Because the discount rate was going down, there would be a disproportionate impact on the valuations. Now the reverse is happening, because the yields are going up, there will be a disproportionate impact on their present value of future cash flows. So it has nothing to do with IT. IT is going down for sure. That is because of a different set of reasons, not
Hmm.
necessarily linked only to rising interest rates. So we should be, and this is not about interest rates. Their hike in interest rates or yields makes it even more important that you don't go in for very richly valued companies or something that is completely out of sync with reality. But now this makes it tougher for those companies to sustain valuations.
Sure. But when these high valuation stocks come, like get beaten down, so when do you think it's time to accumulate them for the long term?
So that again, Nandita, will be a stock call. You need to
Hmm.
really see what you have to do, that bit in terms of where is the industry poised? Is that growth going to continue to remain undisrupted? Those will be the essential factors. So, for example, who would have imagined, year and a half or 18 months back, that IT would come off? We were all assuming that this digitization is going to continue for a long time, and they will have a 5-7 years of continued growth at the same rate. That's not going to happen. So as the economy navigates through this period of high inflation, we'll have to see how we are going to really rejig. Will it be the domestic guys who are going to see an altered growth trajectory? Will it be the China plus one play? And all of these, to varying degrees, they have priced in some part of the growth. We have to see where the maximum slippages in growth are, and compare it to the maximum slippages in valuation, and see where you can really start to fish.
Sure. Big names like Ray Dalio as well as Nuveen Rubini have come out and said that U.S. stocks are at risk of tumbling somewhere around 30 to 40% if the Fed funds rate reaches 4.5 or 5% or so. But at that point of time, do you think it makes sense to take exposure to U.S. stocks, because in the long term, of course, they will bear fruit, right? So should Indian investors look at taking exposure to U.S. stocks, say next year?
I don't have a very firm view on this, Nandita, because I'm not very familiar with, stock wise. I don't do a lot of stock specific research on US stocks. It's hard to say. But largely, if you see, there have been a camp of investors who have thought for long that this has extended for a long time in the US. And this pain of higher inflation, interest rate are to stay. And
Hmm.
therefore, this is going to be a prolonged period of pain for US equities. And evidence to that, the fact that now the growth will shift to emerging markets, and especially India is also at the forefront of that,
Yeah.
is playing out in the market right now. So there should be a great opportunity in India for sure in terms of demographics, and if we get our act together, there might be a lot of growth opportunities in India itself. But I would still be fairly bullish on US tech because those are companies that you don't find in India, companies with that kind of mode which have established, and you can't think of some of those companies getting replaced by challengers from any part of the world. And those companies are rich, and if the valuation stretches to the other end, that will definitely be an opportunity I would suggest we should take very seriously.
Right, and just for our viewers' benefit, we also have a series as to how to invest abroad. So you
Yes.
guys can go and check it out and see how to take exposure to US stocks if you really are interested in that. Uh, and moving on, ML, next week we have the RBI's meeting taking place, and global central banks have really amped up their fight against inflation. We've also seen RBI hiking rates since the start of this fiscal. Do you expect another 50 basis point rate hike, given the fact that inflation here as well has once again come up to the 7% mark?
Absolutely, I would think so. I would think so. And like I said, even the RBI cannot remain complacent. Although we all know that we have seen the inflation rates at these levels for in the past. So it's not as challenging for us as for the US at this point in time. But at the same time, we can't be complacent either. So we will have to raise rates because you have to keep an eye on the rupee, which is the most important variable for us. And
Can move
I
above the recent
presume
mark.
a 50 basis point hike will be in order.
Sure. So 50 basis points we can expect next week. And of course, ML says that India is better poised when it comes to our global peers. Thanks a lot for taking our time and putting things into perspective for us, ML. I hope to have more such chats with you in the future. Thanks a lot, guys, for
Thank you.
watching
Thank you
and
so
stay tuned to
much.
Money Control.
Thanks, Nandita.